Hi, this is James Heckler, Mortgage Advisor, NMLS number 214601. And today I just want to bring to you 10 of the most common questions that I get asked by first-time buyers and people considering their first purchase of a home. Well, absolutely. Buying a home could be a really exciting process, a big milestone in life, but it can also be overwhelming and confusing. There's a lot of jargon, there's a lot of terms, there's a lot of factors to consider. And so I'm hoping that this today will help you in your journey to become a homeowner. And so the first question I want to cover, I don't get asked this a lot, but it is important, and that is, what is a mortgage? Well, a mortgage is simply a promise to repay that is secured by real estate. So basically, it's a note that you sign that you're going to pay based on the terms that you've been giving. And if you do not pay back the mortgage, then the lender can take the property away in a foreclosure and sell it to recoup some of their losses. So it's simple. It's just a promise to repay tied to the security of the property. And the next question that I actually do get asked a lot is, what's the difference between a pre-qualification and a pre-approval? And that's pretty simple. A pre-qualification is a conversation. We're going to ask about income, about obligations, about credit and assets, and you're going to give me the information that we need to be able to determine your qualifications, as well as what loan programs would work for you that I can give you feedback on, and you can see if that fits your needs. And if it does, the next step before you go out and seriously start looking is pre-approval. Now, sellers and sellers' realtors are requiring that step now before they risk taking the seller's property off the market into escrow. They want to make sure that you've been pre-approved and you've basically spoken to the bank and you've got your money lined up. So a pre-approval is just providing the documentation that supports the verbal conversation. We're going to ask for things like pay stubs, W-2s, tax returns if you have self-employment or other type of income rather than just on pay stubs. We're going to ask for bank statements, and then any other information that's material in making that decision about approving your loan. Once we get that, we run a credit. It has to be our own credit, and then we approve the loan. We submit that to the underwriting engines and we get an approval back. That's a pre-approval, different than just the verbal conversation of what you may qualify for. And so the next question that I wanted to cover is, what are the steps that I need to do to secure the loan, you may ask, okay? And so you're gonna, as I already said, have to provide pay stubs. You'll need to provide W-2 forms or tax returns, depending on your employment status. You'll need to provide recent bank statements to show your ability to make the down payment, your ability to cover the closing costs. In some cases, your reserves, what you're going to have left over. Not all loans require that, but some do. And of course, any other documentation that is necessary that the underwriter will want to see to support the underwriter's loan decision. And so the fourth question is, how can I find out what my credit score is? And the credit report, basically, you can find out from annualcreditreports.com once a year for free. You can get a copy of your credit report. And or if you're denied a loan of some kind, you can also get a copy free. But that does not come with a credit score. The bureaus, Experian, TransUnion, and what's the other one, Equifax, they charge extra for the credit scores. Now, you can get your credit score from a credit card. They normally provide that now, an Advantage 3 or soon to be Advantage 4 score. And you can also get that from a subscription service, something like Credit Karma or something like that, where you pay a fee to get, I think it's 30 days free or something like that, but then you pay an annual fee to be able to access that at any time. Now, the kicker with that is that neither the Credit Karma or subscription service, whatever it may be, or the credit card provided credit score is not going to be exactly the same as the mortgage credit score. And that's because they use different algorithms. They use different models. And so a mortgage credit score is a little heavier weighted. There's a bigger obligation. There's a greater liability to the lender. And so it's a little bit more weighted. And what is a credit score? It's just basically a predictor of foreclosure. So based on your past patterns and current patterns of spending, the lender can determine from the credit score what the likelihood of you being a risk of foreclosure is. And that will determine the interest rate that you get, the amount of money that you have to put down as far as a down payment is concerned, and even the type of loan that you can get. So credit scores are important. And if you want to know your mortgage credit score, you need to have a credit company pull that to see exactly what the mortgage score will be. The credit card score and the credit subscription scores, they're going to be close enough to kind of get an idea of where you're at. But when you take that next step and go pre-approval, you'll get that. Another thing that people ask about is, what are my responsibilities during the loan process? What are the things that I need to do to have a successful close of escrow and a successful loan? And so here's a few things to think about. You don't want to change jobs. Stability of income for 2 years is important in the lending decision. And so you don't want to become self-employed recently as well, because then you don't have 2 years history of self-employment, and self-employment can be a greater risk. So if you've been working and now all of a sudden you decide to go self-employed, consultant, whatever the case may be, you may have to wait a while before you file a couple of tax returns that you can really qualify for a mortgage. Another thing that's really important is don't acquire new debt. Don't buy a new car before you get a mortgage. Don't go out and purchase, a big ticket item and get a new account of any kind. One thing is it'll lower your credit score for a period of time. It goes back up after a period of time, but it also affects your debt to income ratio. We look at how much income you have and what percentage of your income is going to go to your house payment and all other debt together. And there's a maximum for that. So you want to get the mortgage first and then get the luxuries afterwards, as long as you can afford them. You don't want to have any late payments on any of your credit cards or any of your loans. You want to keep all of those payments current. Definitely don't spend money that you're setting aside for closing. When you're becoming a homeowner and you're considering that, one of the first things that anybody should do, whether you're going to be a homeowner or not, is establish an emergency fund where you have several months of expenses set aside. And so as you're preparing for owning a home, you're saving for a down payment, you want to have that separate from your emergency fund, because God forbid you're looking for a home, you're in the middle of it, and something goes out on the car, or you need a new air conditioner on the home that you're selling or whatever, and you have to tap the money that you were saving for your down payment. Don't apply for any new loans. We already kind of discussed that. You can lower your score and raise your debt to income ratio. Don't change banks or make unusually large deposits into your bank that you can't track. So, we're going to look at 2 months bank statements. We're going to see the history of that asset for your down payment and make sure that that came from a legitimate source and that it has not been borrowed. If you're getting a gift from a family member, there's a process that we use to document that. That's fine. But if you just got a bunch of cash under the mattress and you deposit that, you've got a problem trying to legitimize that deposit. Okay, so you don't want to do that. And then another thing is, don't agree to co-sign for anybody, because a lender is going to look at it on a co-signed obligation, 12 months history of the main borrower making the payments before we will relieve you of the obligation in qualifying. Now, if you do co-sign for somebody, make sure that you are co-signing and you're not the primary borrower, because if you're the primary borrower, even though somebody else is making the payment, that obligation can be counted against you. Okay, so don't be doing that for at least 12 months prior to wanting to buy your own home. So those are some of the things that you need to consider that you'll need to do to have a successful escrow. Question number 6 is, what does it mean to lock in a rate? So the mortgage interests change daily, sometimes several times a day, depending on the volatility of the marketplace. And so once you get pre-qualified or even pre-approved, you're going to be subject to the fluctuations in the marketplace until you get into escrow and officially apply for the loan on that property. And then you can lock in the interest rate for a period of time. Now, there are some exceptions to that. There's a thing that we call lock and shop. And that's where we lock you in for a period of time while you're shopping for a loan. You don't even have to have a property. The issue with that is that it's generally at a higher interest rate because there's some ambiguity to how long that lock's going to last, how long you're going to need. And so it's basically padded, as it were. So it's something I don't normally recommend. So once you get into escrow, you can be guaranteed that interest rate once you're locked in for the period of time that you lock, 30 days or 45 days or whatever, as long as you don't change your qualification status to where you don't qualify for that loan during that period of time. Another question we get is, what is loan to value? Well, loan to value is simply the reciprocal of your down payment. So if you're putting 5% down, the loan to value is 95% down. I'm sorry, 95%. If you're putting 20% down, the loan to value is 80%. Why is that important? That's the amount that the lender is risking. That's the loan amount, okay? To the value, it's a ratio of the loan amount to the value of the home. And so the loan to value will determine interest rate, loan product, things like that. So that's something you need to consider. Now, a lot of people get hung up on having to save 20% down for down payment. You don't have to do that. Small down payments, 3.5% for FHA, 3% for a first-time home buyer, 5%, for others. You can still get a pretty good rate. And as long as the payment is affordable, you don't have to wait till you get 20% down to buy something. And then another question we get is, what's included in the mortgage payment? Well, generally the principal and the interest to pay back the loan over the period of time that you're amortizing, it's 15 or 30 years, whatever it is, principal and interest is included. There is the exception of an interest-only payment, but we don't use that very much now, so that's just kind of a limited thing. The other things are the taxes and insurance. Should it be required or should you choose it as an option? So if you put less than 20% down, it often is required that the monthly amount for the taxes and for the insurance are added to your principal and interest. So they collect one amount, put the taxes and insurance in an account that earns you a sum of interest, a small sum of interest, and then the lender makes the payment for the taxes and the insurance as they come due from that account, okay, which is your account. So when you pay off that loan, whatever money's in there, you get back. But if you put 20% down or more, you generally don't have to do that, but it is an option available to you. Some people just don't want to be bothered having to pay their taxes twice a year or once a year for their insurance in that big lump sum. They'd rather divide it up over the 12 months, have it included in their mortgage payment so that it's handled and not have to worry about it. So that's what's included in the mortgage payment. It does not include homeowners association dues. You pay that separately to your homeowners association if you happen to have that. And another question that we get often is, what is mortgage insurance and why do I need it? Well, mortgage insurance covers the lender for loss of principal. So if you're putting less than 20% down, it's normally required. And that's because if the lender were to have to take the property back, if you didn't make the payments, they had to take the property back, they have to fix it up, they have to market it, they have to sell it. And there's going to be costs associated with that. And if you put 20% down or more, they may break even or maybe even make a little. But if you put less than 20% down, they're going to lose money. And so the process of private mortgage insurance, PMI, has come about to ensure the lender, the PMI company, you pay the insurance premium that the lender requires, but the mortgage insurance company covers some or all of the lender's loss in the event of foreclosure. Some types of loans like FHA, we call it mortgage insurance premium instead of private mortgage insurance, it's MIP. And that's required no matter how much you put down, just because FHA is only an insurance program. It's a government-backed insurance program. And so that is there, regardless. For vet loans, for VA loans, there's no monthly mortgage insurance, but there is an upfront VA funding fee. If you have 10% or more service-related disability, that's waived. But otherwise, you pay this fee to the Veterans Administration. And that's how they administrate the program as well as cover the losses. Great benefit. If you're a veteran, qualifies for a veteran loan, give me a call because not enough people are taking advantage of that. And it's an absolutely fantastic benefit that you as a veteran have earned. So that's why it's necessary. That's what it is. And then lastly, the last question that I get often asked is, what should I expect on closing day? Well, in California, the way a closing takes place is that once all the loan approval conditions are cleared and you're ready to close, the lender sends a closing disclosure, and that basically covers the costs and the expenses and the down payment that should pretty much match the initial disclosure at the time of application, called the loan estimate, and they should be very close. Okay, because things are going to change a little bit. Some of these things are daily prorations or monthly prorations or things like that. But the closing disclosure, once you acknowledge it, begins a 3-day waiting period before you can sign the loan documents. Once you sign the final loan documents, then the escrow gets it back to the lender. The lender schedules it to fund. And in Southern California, in Los Angeles area, it funds one day, the lender wires the money to escrow, and then the documents are sent to the county recorder's office and it records, closes, it's yours the following day. Some other states have closing days where you actually go to the escrow or the title company and sign the loan documents, and they give you the key. Everything happens right then and there. Not in California. It's a little bit differently, done a little bit differently. So that's it. That's 10 of the most common questions that I get asked by first-time buyers or people considering becoming a first-time buyer. And so if you have any questions, you want to get pre-qualified, you want to get pre-approved, or you just want to know ahead of time what that process looks like, because starting early, even if you're not ready yet, starting early is advisable. My job is to help you make smart choices about money when it comes to the purchase or refinance of your home, your second or vacation home, or your investment property. And so I'm more than happy to guide you along, take a look at what's on your credit, see if there's anything that you should be doing to improve it. I don't charge for that. I don't do credit repair or anything like that, but I've been doing it long enough to be able to look at it and say, if you go do this, this, and this, you'll be able to get a better loan, or you'll be able to get approved where otherwise you wouldn't. So give me a call at 661-714-2145. If you have any questions, or anybody that you know and care about has any questions about becoming a first-time buyer. Thank you so much. Take care. Have a wonderful day.